Hi there, welcome back to Kneppy Analysis. In today's video, I am going to be discussing AGL. This is a request from a viewer of this channel. I have traded this company in the past, but not a shareholder right now, unfortunately, because right now would be a great time to be trading AGL. When I say trading, I'm not talking about day trading, buying and selling on the same day. I'm talking about having a short-term position in this company just because the share price is in a beautiful short to possibly even medium-term uptrend. But I'll talk about that later in the video. Now, I've already given it away that I am not a shareholder of AGL now, but I have been in the past. And to be frank with you, I will never be a long-term shareholder of this company because simply it is not a high-quality company. And I prefer only to hold high-quality companies for the longer term. For those who have been living under a rock for the last 100 years and don't know what AGL does, in fact, AGL has a pretty long history in Australia. I'll talk about the history later in the video. It's quite intriguing history. This company is mostly known because they are an energy retailer, and that is one of their three operating segments. So the three operating segments are customer markets, which is the retailing of electricity, gas, also telecommunications like broadband, mobile, and voices, and they provide those services to residential, small, and large business customers. The other two segments, probably a little bit less known, that includes integrated energy, which operates AGL's power generation portfolio and other key assets. So that includes their coal, gas, and renewable generation facilities. And the third segment is investments. That comprises their interest in a few companies. And to be fair with you, this is a fairly small segment in their business. So I won't dwell on that segment at all. Now, their operations, this is found or was found, I think, in their annual report. They have operations or they have their assets, probably is the best way to put it, primarily in Southeast Australia. They have one asset in WA, but most of them are in New South Wales, Victoria, a few in southern Queensland, and one or two in South Australia as well. So they have gas-fired, coal-fired, wind, solar, hydro, also grid-scale battery. So if you like more information, just go to the website or go to the annual report and you'll get a lot of information about this company and their assets. Now, a very important part of AGL's business plan and future is their decarbonisation roadmap. And again, this was found either in their annual report, or I think this could have been found, I found this particular slide in their half-year presentation. So this is talking about their road to becoming net zero, that sort of thing. To be honest with you, I don't really care about this all that much as an investor, particularly a short-term trader, but some of you who are interested in ESG issues might be or might want to know more about their decarbonisation roadmap. Now, the first part of this particular plan was the closing of one of their power stations in April 2023, which was 3 months ago, and they've done exactly that. So that's one of their coal plants, one of their old coal plants, and they do have targets by the end of 2030, some more targets by the end of 2035, and continued ambition to be net zero by 2050 for scope 1, 2, 3, 1, 2, and 3 emissions. And to be honest with you, I believe they should be aiming to be net zero well before 2050. But that's just my opinion. The current managing director and CEO of the company is Damian Nix, and he's been with AGL for over 10 years. He became the chief financial officer in August 2018, then became the interim chief executive officer in September 2022, and then he was confirmed as the official managing director and CEO in January 2023. So hasn't been in this role for very long, so can't really tell you anything about his way of doing business. But at this point in time, the market likes what he's doing because the share price has been an absolute tear over the past few months. And to be honest with you, it may not be because of Damian Nix. It could be just because of your overall expectations that AGL, the worst for AGL, is now behind it, and there's good things in store during the next few years. Now, on to why I will never be a long-term holder of this company. It comes down to the quality. You don't want to own low-quality companies for the long term because they don't give good returns. And this has definitely been true for AGL. So what I do to determine the quality of a company, any company, is look at the revenue growth. That's the first thing I look at. And when I talk about or look at revenue growth, I'm talking about at least 10 years. I also look at 5 years, 3 years, trailing 12 months. Also look at return on invested capital, not only the current return on invested capital, but also over a 10-year period. And then I also look at total return over that 10-year period as well. Now, when you look at revenue growth over the last 10 years, it's quite sluggish, quite slow, only at 2.3% per year. In fact, over the last 5 years, exactly 0%. But revenue has started to grow, started to accelerate up to 14.8% over the last 3 years. Return on invested capital, 6.9. We want that to be much higher. And I think AGL will struggle to get that higher than 6.9 because of the history. Talk about the history of return on invested capital in a second. EV to EBIT, which is the valuation metric, 5.9, which is probably fair for this company. And the total return over the past 10 years is fairly similar than the revenue growth at 2.4% per year. So would you be happy getting a 2.4% return for a company you've owned for 10 years? More than likely not. But there are reasons why that total return is so low. And you'll be able to see that when we look at the long-term chart. So to find AGL as a low-quality company, and I only trade low-quality companies, and these are my thoughts on AGL when I did a more in-depth look quite a few months ago. Low quality with sluggish revenue growth, low return on invested capital, and that low return on invested capital has been between 4 and 6 over the last 15 years. So that means don't expect a high return on this company unless they can increase their return on invested capital. But history suggests that this company struggles to increase their return. So I don't expect much higher returns than what the company is experiencing right now than 2.4% per year. Maybe it's going to be a little bit higher just because the share price is right now, but don't expect high returns for this company moving forward. Now to a few facts in regards to AGL. This is from July 16. Apart from the share price, I just updated the share price because the share price actually has increased 40 cents over the last 3 days. 3 trading days. Anyway, AGL founded in 1837. I'm pretty sure it was founded as Australian Gas Light or Gas and Light. And it listed on the ASX in 1871 as Australian Gas Light. And in fact, it was the second company to list on the ASX. In fact, the gap between the first company and the second company was quite a few years. So at one point in time, on the ASX, there was only one company you could trade in. So that's interesting in itself. Now, the largest shareholder, or one of the largest shareholders right now, is Kneppy Partnership, which is that Mike Cannon-Brookes and Gork Ventures, whatever it is, 10.4% of the company. That has decreased a little bit, but not by much. Current share price, $11.80, and with 672.75 million shares on issue. That means the market cap of this company is around $8 billion. Now let's have a look at the financial state of AGL, looking at the trailing 12 months. So this is the first half of financial year 23 and the second half of financial year 22. Soon we'll have a look at the financial year 23 numbers. They should release their results within the next month or so. So by the end of August, I believe. And now revenue, $15.1 billion. Now this company was not or has not been profitable over the last 12 months. In fact, loss-making by $770 million, and the majority of all that loss, in fact, by far the majority of that loss, is because of impairments and one-offs. So when you do see impairments and one-offs, that doesn't mean this company is massively loss-making, burning through lots of cash. But in fact, they are burning through cash. So even though they were operating cash flow positive by $603 million, they're actually free cash flow negative by $30 million. So that is a slight red flag, particularly if they keep being free cash flow negative over the next few years. But I doubt that. I think they'll return to becoming free cash flow positive in financial year 23. Probably. Don't count on that. However, operating margin 7.6 and equity 5.4 billion. And the reason I look at equity is that's sort of the value of this company. That's probably the best way to put it. So you could say if you saw the market cap of this company go way lower than 5.4 billion, you might see some value there. So at this point in time, the value of, or the market cap of AGL is $7 billion. So the price to book of this company is above 1. And for those who don't know, book is the same as equity. One thing I like to do whenever a company releases a financial results and I'm looking at research on the company is to look at the disaggregation of revenue by divisional segments and also by geography. Now, we don't have to worry or look at the breakdown of revenue by geography for AGL because all their revenue is generated in Australia. So we can look at the breakdown of the revenue or the segregation of the revenue by the different segments. And remember, they have 3 segments: customer markets, integrated energy, and investments. And only $10 million of this company's revenue was generated by their investments. So we really can ignore investments. But if we focus on customer markets and integrated energy, we can see almost an even split between these 2 segments when it comes to revenue. $4.1 billion of revenue in customer markets, $3.7 billion of revenue through integrated energy. And if we look further down at underlying EBIT, 75% of this company's EBIT was generated through integrated energy and only 25% through customer markets, which tells me straight away that integrated energy is a more profitable arm or division segment of this company. Now, I can't quite remember when this company was mentioning demerging of their 2 big businesses, whether that was the demerging of customer markets and integrated energy. And if they went through that demerger, by far, the part of the business I would be more interested in taking an investment or putting an investment in would be integrated energy. Customer markets, not so much because of the low profitability of that particular segment. Now, arguing against me in saying that is I only looked at 6 months of results. And if I go back through time, there is a possibility that integrated energy is less profitable over time than the consumer markets, or whatever it's called. Consumer markets, customer markets. Consumer, customer, same sort of thing. So another thing the company has done is they've broken down their revenue into or by product and customer type. So customer type, consumer, business and wholesale, and products, electricity, generation sales to pool, gas, and the other 2 we can ignore, rendering of services and other revenue. And if we look at where most of the revenue is generated, it's in wholesale or generation sales to pool. Coming in second is electricity to consumers, and coming in third is gas to consumers. One of the main red flags I found when it comes to AGL's half-year financial year 23 results was just their unimpressive free cash flow. Now, there is an explanation here to why their free cash flow was negative for the half year. So they mention here that their operating cash flow, which is not free cash flow, and EBITDA conversion rate impacted by working capital outflows. So you always have to be careful when you do look at the cash flow statement in itself, without looking at anything else, that the free cash flow and operating cash flow of a company can be impacted by working capital changes. So we're talking about, for this company, margin receipts, payables and receivables, and also inventory. And I have seen this happen with a lot of companies where companies' cash flow can be significantly impacted in 1 quarter, 1 half, or 1 full year by working capital changes, and then that completely reverses the next period. In fact, I was listening to a podcast the other day. This was an American-based podcast, and they're talking about why they sold out of a company recently. And the whole reason they sold out of the company was because this particular company went from being free cash flow positive to free cash flow negative, and they freaked out and they sold. You do have to be careful of that. So always look at working capital changes. And AGL have tried to tell us in their commentary, in this particular slide, in their presentation, why operating cash flow and free cash flow was lower in this particular half year. So large working capital outflows in the half impacted operating cash flow, in particular payables and margin calls. And before I get into the pool generation volume in this particular slide, let's go back again to the previous slide because they also mentioned here they do expect the cash conversion is expected to revert back to the company's historical rates by the end of financial year 23. So we'll be able to see if that is true when we see this company's full year results by the end of August. Now to the pool generation volume, we can see how much these assets or how much electricity these assets are generating. And the main thing I'm looking for here is changes from last year to this year. And it's really good they've broken down all their particular assets. And we have Bayswater, Liddell, Loy Yang, Torrens, Abarca Inlet, Kawanana Swift, which I have no idea what they are, but then we see some renewables, South Australia Wind, Vic Hydro, Vic Wind, New South Wales Solar, New South Wales Wind, New South Wales Hydro. And if we look at growth, by far the best growth in all these is Victoria Hydro. In fact, that's up 156%. We've also seen some pretty good increases in New South Wales Solar, up 50%, other gas up 65%. And what else is positive here? Barker Inlet up 46%. And then we have a generation type breakdown. Coal down 11%. By far, most of this company's electricity is generated by coal. We also have gas, wind, hydro, and solar. As I've already mentioned in this video, one of the things I look at in terms of understanding whether a company is high quality or low quality is just looking at the revenue growth. And when I usually talk about revenue growth, I'm referring to revenue per share growth because that takes into account whether a company is increasing their shares or even decreasing their shares on issue. And I think AGL over the past 10 years have actually increased their shares on issue because revenue, without looking at revenue per share, has grown from 9.7 billion to 13.2 billion. The other things I've included on this particular chart is operating cash flow and free cash flow. And the main thing here is even though in the trailing 12 months, this company has been free cash flow negative over the past 10 years, and this is just looking at financial year numbers. So the last numbers here are from financial year 22, so no half year results here. Every single year, this company has been free cash flow positive. The lowest was back in 2014 when they were free cash flow positive by 1. The best year by far was 2018, not in terms of revenue, which was 12.8 billion, but in terms of operating cash flow, 2.1 billion, and free cash flow, 1.4 billion. And it should not be a shock that the share price and valuation of this company did reach its peak back in 2018. Although, if I remember correctly, the peak in this company's share price and valuation was 2017. So the market was looking forward to that really good 2018 year, but we're able to confirm that when we look at the chart later in the video. Now comes to dividends. And another way I can determine whether a company is high or low quality is just by looking at the dividend history. So this is AGL's dividend history over the past 10 years. And for a high quality company, typically dividends increase over time. So maybe back in 2018, I might have declared AGL as a high quality company because we did see, well, this company did increase the dividends between 2013 and 2018, but that was a peak in dividends. And ever since then, dividends have been dropping. And you might be able to argue with me right now, and maybe successfully, that this is a low point when it comes to dividends. And from now, dividends are going to go back up. Dividend yield 2.4%. And if they do get dividends back up to, say, 60 cents per half year back in 2019, this company might be looking quite cheap at current share price levels. And another way we can determine whether a company is cheap or not is just by looking at some valuation metrics, PE ratio, price to book ratio, price to operating cash flow, that sort of thing. So the PE ratio, now this is, I had to be a little bit tricky here because they were not profitable. So I went back to the financial year 22 numbers and I used that for the earnings. So if you do use financial year 22 earnings, this company has a PE ratio of roughly 9. Price to book at 1.4 has been less than 1 over the past year. And so you might say if the price to book ratio gets less than 1, maybe there is some value there. Price to operating cash flow 12.8. I would prefer that to be a little bit lower, but again, they did mention why the operating cash flow might not be as high as it probably should be, based off working capital changes, and also did a reverse DCF based off the operating cash flow. And for this company to justify the current valuation, they'd have to grow their operating cash flow at 5.2% per year. And the very fact that they did mention that operating cash flow was probably lower than it should be in the last half year, I think this company can hit a 5.2% increase in the operating cash flow. However, this company could be experiencing quite a few headwinds over the next 5 to 10 years. I just don't know, because this is a low quality company. Now, in saying that, as they transition more and more to renewables, maybe this company can increase their return on invested capital. And maybe this company can increase their margins, that sort of thing. And maybe this company can become a high quality company. And another way we can determine whether a company is high or low quality is just by looking at the long-term chart. And I thought I did include the weekly chart, but I decided to look at the monthly chart for this company going back to 2002. Now, to be honest with you, we did see the nice increase in share price from 2002 all the way through to 2017. For the share price increased from $8 to a high of $28. So that's a okay return over a 15-year period. I would want probably higher returns than that, but the share price was going up. It was in an uptrend. That uptrend came to an end in 2019, 2020, and then the share price absolutely fell off a cliff in 2020. In fact, the share price fell from about $20, $21 all the way down to a low of $5 towards the end of 2021. But the tide has turned. It does look like the share price of AGL is trying to move into a longer term uptrend, definitely in a short to medium term uptrend, and we confirm that in the next slide when we look at the daily chart. But we have seen the share price rise quite significantly for 3 months in a row. And if we turn our attention to the daily chart, this goes back to, back exactly 1 year ago. And to be fair with you, share price not really doing anything from July last year all the way through to March of this year, going sideways. Share price did hit the long-term uptrend, not long-term uptrend, sort of the medium-term uptrend in March. And that share price was about $6.80. Share price started to move up in April, and the share price moved to a nice little resistance level at around about $8.80. We'll say $8.90. Share price took a while to get above that resistance level, but as soon as it got above $8.90, it just took off, and the share price has rallied quite a bit over the past 2 months. The next 5 companies I'll be featuring in Kneppy's analysis video series include Technology One, which will be the next company, and then I'll look at Universal Stores, and then WH Soul Pattinson, then Macquarie Technology Group, which actually recently did change their name, and then Dusk. If you do have any suggestions of companies you'd like me to feature in Kneppy's analysis, just leave those suggestions in the comment section of this video, and I'll see what I'm able to do. I won't be able to satisfy everyone out there, but some I will. In fact, today's video was simply because of someone's request. So don't be shy, put your request in, and maybe you'll be lucky. And that's all I have for this video, looking at AGL. If you do have any thoughts, any questions about AGL, maybe you have more insight than I do in regards to this company, particularly about their future, I'd love to hear your thoughts. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.